Buying a home, it is literally one of the absolute biggest financial decisions we are ever going to make, right? I mean, it's the dream. We're all picturing that perfect wraparound front porch or maybe a huge backyard of your own. But listen, before you even start shopping for that dream home, we need to lay down a rock-solid foundation. Welcome to today's Explainer, where we're mapping out the blueprint for mortgage pre-approval success. Let's build it.
Now, the mortgage process can feel like a giant puzzle, but we're going to break this whole thing down into 4 totally manageable steps. 1. The power of pre-approval. 2. What mortgage lenders actually want. 3. Pre-approval versus pre-qualification. And finally, number 4, protecting your financial profile.
Okay, Section 1, the power of pre-approval. This right here is the crucial first step in your entire home buying journey. Getting pre-approved is, hands down, the smartest move you can make before you even step foot into a single open house. Basically, it tells sellers that a recognized lender has actually looked at your finances and genuinely believes you qualify for a loan up to a specific amount. It sets your budget in reality, and more importantly, it signals to sellers that you aren't just window shopping, you are a serious buyer ready to make a move.
Moving right along to Section 2, what mortgage lenders want. We are going to construct our blueprint using what we'll call the 4 pillars of financial readiness. And here they are: your credit score, your income and employment, your debt to income, and your down payment. The absolute beauty of these 4 specific pillars is that they are entirely in your control. Lenders are going to heavily scrutinize every single one of these, so let's unpack exactly how you can master them.
All right, pillar number 1 is your credit score. Think of this as your actionable homework long before you ever submit a loan application. A higher score? Well, that is the magic key to unlocking better interest rates and much lower monthly payments. So review your credit report thoroughly, correct any weird errors you find, and this is absolutely crucial, never, ever miss a current bill payment.
Pillar 2 is simply proving you can actually pay the lender back. Mortgage companies, they demand to see steady employment and reliable income. You can't just tell them you make good money. You have to physically prove it. So get organized early. Pull together your recent pay stubs, your tax returns, bank statements, W-2 forms, the whole shebang.
Okay, let's slow down for just a quick second here, because Pillar 3 introduces some technical financial jargon. Debt-to-income ratio, or DTI. Basically, this is a vital metric that compares your existing monthly debt payments directly with your monthly gross income. Why does this matter? Well, a lower DTI proves to lenders that you have the financial bandwidth to comfortably handle a brand new mortgage payment right on top of all your existing financial obligations, like, say, a car loan or student debt.
Our final pillar is the down payment. Now, while some loan programs definitely allow for smaller down payments, aggressively saving up and putting more money down can drastically improve your chances of approval. Plus, bringing a larger lump sum to the table immediately reduces your monthly payment and helps you secure much better loan terms overall.
Once your pillars are nice and strong, you gotta remember this golden rule. Compare your offers. Seriously, do not blindly take the very first pre-approval terms you get. Interest rates, fees, overall loan terms, they can vary wildly from one mortgage company to another. Shopping around is 100% worth your time, because even a slightly lower interest rate could save you literally thousands of dollars over the lifespan of your mortgage.
So, moving to Section 3, pre-approval versus pre-qualification. We really need to know the vital difference between these 2 frequently confused terms.
There is a massive game-changing contrast here. Pre-qualification, well, that's usually just based on information you self-report. You type some numbers into a website calculator and you get a rough estimate. But pre-approval involves a rigorous, document-verified review by a lender. Because of that hard proof, sellers view pre-approved buyers as significantly more serious and prepared. Which brings us to our final step, Section 4, protecting your financial profile. This is all about maintaining your hard-earned status all the way until closing. Welcome to the financial freeze period, or as I like to call it, the danger zone. Once you are pre-approved, your financial profile is incredibly fragile. Do not apply for new credit cards, try to avoid changing jobs, and please, this is definitely not the time to take out a massive loan to buy a boat or furnish your entire new house on credit. Taking on new debt right now can instantly lower your credit score and spike that DTI we just talked about, which makes getting your final approval so much more difficult.
The stakes during this waiting period literally couldn't be higher. Remember, a pre-approval is a strong indicator, sure, but it isn't a guarantee. In fact, any of these impulsive actions could completely affect your final mortgage approval. Your daily habits are basically under a microscope until closing day. You absolutely have to protect your profile at all costs.
Ultimately, getting a pre-approval completely transforms how you hunt for a house. Knowing your exact estimated borrowing limit allows you to purposefully focus only on homes that fit squarely within your actual budget. It saves a ton of time, it prevents you from falling in love with a house you simply can't afford, and it just makes the whole buying process infinitely smoother for everyone involved.
Getting pre-approved puts you in a true position of power. By utilizing strong credit, steady income, careful budgeting, and responsible financial habits, you are setting yourself up for real success. So, I'm going to leave you with this final question to think about. Do you have the responsible financial habits to confidently build your home buying blueprint today? Take a hard look at your credit, evaluate those savings, and get organized. Your dream home is out there, and now you've got the blueprint to go get it. Thanks so much for joining me on this explainer.